You wake up, grab your phone, and the headline hits like a slap. Gold, down 13% in a day. Not a slow drift, not a gentle pullback, a straight down candle. And if you're thinking, gold is supposed to be the safety net, so why is the safety net tearing? Good. That question is the whole story, because when gold falls this hard, it usually isn't a gold story. It's a liquidity story. It's the market screaming, somebody needs cash, right now. Here's what most people miss. Gold doesn't always crash first. Gold crashes when the system is under strain somewhere else. Risk cracks, funding tightens. Then the most liquid good asset gets sold to keep the machine running. So today we're going to decode what a sudden gold dump really signals, how it spreads through stocks, bonds, crypto, and commodities, and what to watch next before the next wave arrives. This is financial education, not financial advice. No hype, no politics, no fear bait, just mechanics. A 13% one-day drop can feel like gold got rejected. But the market isn't judging gold today. The market is doing math. And the other number floating around is even scarier. Over $5 trillion of gold value vanished in 48 hours. Let's be precise. This isn't $5 trillion in cash thrown into a fire. It's mark-to-market repricing. It's wealth measured in price shifting lower, very fast. That speed matters because speed is what breaks portfolios. Slow declines give you time to adjust. Fast declines trigger rules, limits, and forced actions. Crashes are not opinions. Crashes are constraints. Gold is marketed as the ultimate safe haven, the asset you run to when systems crack, the store of value when currencies bleed. So why would it crater? Because safety is about the long run, but crashes are about the next 24 to 48 hours. In a panic, institutions don't sell what they hate. They sell what they can. They sell what has buyers. They sell what settles fast. They sell what raises cash to meet calls. And gold is one of the deepest, most liquid pools on Earth. That liquidity is a feature until it becomes your emergency exit. Let me show you the invisible domino line. Step 1. Something else breaks. Stocks wobble. Credit spreads widen. Volatility spikes. Your portfolio loses value, and risk models flash red. Step 2. Leverage gets exposed. Hedge funds, traders, and even conservative portfolios use leverage indirectly. Futures, swaps, options, structured products, financing, short-term borrowing. Step 3. The margin call arrives, not tomorrow, today. Post-collateral. Wire cash. Reduce exposure. And here's the trap. When you must raise cash fast, you sell the cleanest, most liquid asset you own. That is often gold. Gold gets sacrificed, not because it failed, but because it is valuable, tradable, and instantly monetizable. A move like this doesn't need one giant seller. It can be a chain reaction of thousands of smaller forced sells. 4 amplifiers turn stress into a cliff. Amplifier 1. Liquidity thins. Market makers widen spreads. Some bids pull back. When bids thin out, small selling becomes big price damage. Amplifier 2. Systematic selling. Volatility control funds reduce exposure when volatility rises. Risk parity funds rebalance when correlations shift. Trend models flip from buy to sell once levels break. None of this is emotional. It's code. Amplifier 3. Cross-margining. Many participants don't post margin for each position separately. Their broker looks at the whole book. Losses in one market demand cash from another market, so a stock drawdown can force a gold sale. Amplifier 4. Stops. Plus, gap risk. Key levels break. Stops trigger. More selling hits. More margin calls appear. The market doesn't choose to fall. It gets pushed. This is why crashes feel like trapdoors. The floor isn't removed gently. It drops. There is a pattern traders whisper about, not because it's magical, but because it repeats in modern financial plumbing. Stocks wobble, crypto bleeds, bonds tighten, then gold is sold. Why bonds? Because in a stress event, yields can jump as investors demand higher compensation or as collateral gets repriced. Financing rates change, haircuts rise, suddenly borrowing against assets becomes more expensive, and when funding gets expensive, liquidation accelerates. Gold becomes the ATM of the crisis. Part 6. Paper versus physical. What people misunderstand. When people see a crash, they picture trucks of gold being dumped onto the street. That's not how modern markets move. Most of the first wave is paper exposure being reduced. Futures positions, options hedges, ETF shares, leverage products that track spot. That doesn't mean physical demand disappears. In fact, sometimes physical tightens while paper sells. Here's the clue. If spot falls fast, but premiums on coins and bars stay elevated, it suggests the sell-off is financial liquidation, not nobody wants gold. So don't mix up two different markets. Price discovery can be driven by financial flows, while physical supply and demand can be moving on a different clock. When you hear 48 hours, treat it like a warning label. Because most forced selling events have a rhythm, the flush. Everything sells, correlations go to 1. The stabilization, bids return, spreads normalize. The reprice. The market decides what the new normal is. The first phase is fast. It's about survival. The second phase is where you learn whether it was just a liquidity event or the start of something deeper. Part 8. The 1983 comparison, headlines versus patterns. You will see comparisons like largest drop since 1983. Whether the exact year is perfect or not, the pattern is the point. In historical stress windows, the first phase is not a reset of beliefs. It's a reset of balance sheets. That's why these events can feel like restructuring phases. Weak hands are forced out, leverage is removed, and the market reorganizes who holds what. The public sees volatility. Insiders see positioning being ripped apart and rebuilt. If you want to understand what is unfolding, ask 3 questions. Question 1. Where is the cash needed? Look for the area that is bleeding and demanding collateral. Question 2. Is this funding stress or confidence? Stress. Funding stress is mechanical, margin, haircuts, financing. Confidence stress is psychological, people refusing to lend at any price. Question 3. Who recovers first? Watch what gets hit. Watch what recovers first. Watch what stays suppressed. That's where the next cycle is being built. If you're trying to read the next move, watch these signals like a pilot watches instruments. Volatility. If volatility keeps rising, forced selling can continue. If volatility peaks and rolls over, the pressure can ease. Credit conditions. Widening spreads and tightening lending conditions mean stress is spreading. Stabilizing credit often marks the end of the worst liquidation. Funding markers. Look for signs of tighter short-term funding, rising borrowing costs, scarcer collateral, more risk-off behavior, gold's behavior. After the flush, does gold bounce sharply on heavy volume? That can signal the forced seller is done. Does it grind lower quietly? That can signal the stress is still building. Relative strength. Which assets stop falling first? The rebound leaders are the early map of the next narrative. Most people only read the headline. They treat gold like a mood ring. But markets are plumbing. Pressure builds unseen. Then a valve opens, and everything moves at once. If you only react after the move, you're always late. If you study the sequence, you start seeing the stress before it screams. This is why insiders sound calm during chaos. They aren't calm because they don't care. They're calm because they're watching the pressure gauges, not the noise. So what do you do with this? First, respect volatility. If you're using leverage, realize the market can move farther than you think in hours. Second, don't confuse a liquidity flush with a fundamental verdict. A forced sale is not a thesis. Third, simplify. Know your position size, know your downside. Know what happens if prices gap while you're asleep. Fourth, keep optionality. Cash isn't exciting, but it prevents forced selling. Optionality is oxygen during a storm. Fifth, separate your time frames. Short-term crashes are about positioning. Long-term allocation is about purchasing power and trust. Don't let a 48-hour shock rewrite a 10-year plan without evidence. Picture a large trading desk on a day like this. The screens are red, not just one market, multiple. Phones are ringing, not with opinions, but with requirements. A risk manager walks over and says, "Your VAR just doubled. Cut exposure." A prime broker message pops up. Margin requirement updated. Additional collateral due. A portfolio manager does quick math and realizes, if I don't raise cash, positions get liquidated for me. So the desk makes a ruthless decision. Sell what is liquid. Sell what can be sold in size. Sell what won't trap us in a frozen market. That is why gold can get hit even when everyone believes in gold. Belief doesn't settle accounts. Cash settles accounts. Another hidden engine is options hedging. When volatility spikes, option prices jump. Dealers who sold options hedge their risk by trading the underlying. If the market starts falling, hedging can become pro-cyclical. Sell a bit to stay neutral, the price falls. Sell more to stay neutral, the price falls again. This doesn't require a villain. It requires math and speed. And when that machine is active across many markets at once, correlations rise, and everything looks like it is falling together. If you want to know whether the forced seller is still active, look for these clues. Clue 1, the shape of the candle. A long lower wick can signal panic selling got absorbed. A clean close near the lows can signal selling pressure is still dominant. Clue 2, volume and spreads. Huge volume with stabilization can signal capitulation. Thin volume with drifting lower can signal bids are still afraid. Clue 3, speed. The most dangerous phase is the fast phase. If the rate of decline slows, it often means the mechanical selling is exhausting. Clue 4, relationships. Does gold stop falling while risk assets keep falling? That can mean gold selling was about margin, not about gold. Does gold keep falling with everything else? That can mean the funding stress is still widening. If you hold paper exposure, your main risk is volatility and forced liquidation. Your enemy is leverage, not gold. If you hold physical, your main risks are premiums, availability, storage, and patience. Your enemy is panic decision-making, not the daily candle. These are different games. Don't play the paper game with a physical mindset. Don't play the physical game with a day trader's heartbeat. I am not here to predict the next tick. I'm here to map the roads in front of you. Scenario A. Liquidity. Flush, then relief. Selling peaks. Volatility cools. Funding normalizes. Gold and other liquid assets rebound as forced selling ends. This is the classic cash raise first, rethink later pattern. Scenario B. Deleveraging wave. Credit stays tight, risk assets keep bleeding, and forced selling repeats in cycles. In this scenario, rallies can be sharp but short because sellers reappear on strength. This is the restructure the balance sheet environment. Scenario C. Stabilization through liquidity support. When the system threatens to seize, liquidity facilities and lending channels expand. That can calm funding stress and allow markets to reprice more slowly. The key is not the headline. The key is whether funding rates and credit conditions relax. Watch the plumbing. It tells you which scenario you're in. Part 18. The top 5 mistakes people make in events like this. Mistake 1. Assuming today's candle tells you the long-term truth. Mistake 2. Using leverage when volatility is rising. Mistake 3. Revenge trading to win back losses quickly. Mistake 4. Selling the best asset to cover the worst decision. Mistake 5. Consuming only narratives and ignoring signals. Events like this punish emotion. They reward process. When gold crashes hard, it often means it is being used as collateral cash out to cover leverage and meet margin calls, because something bigger is straining the system underneath. If you are active in markets, keep it boring and disciplined. Check your leverage. If you're leveraged, ask, what happens if it gaps another 5%? Check your liquidity. Can you exit without getting wrecked by spreads? Avoid impulsive entries. Big red candles tempt people into bad timing. Use limits, not panic clicks. In chaos, prices can overshoot both directions. Track one thing. Is volatility calming or accelerating? If you're a long-term investor, your job is even simpler. Identify your real exposure, direct and indirect. Make sure you can survive the next week without forced selling. Wait for the market to show its hand. Stabilization first, narratives later. Write down what broke first and what held up. That single note is often worth more than 100 headlines. Watch the rebound quality. Fast snapback with heavy volume is different than a weak drift. A real turn usually comes with tighter spreads, calmer price swings, and fewer sudden air pockets. And remember, surviving beats being right in storm. When an asset that is supposed to protect wealth starts collapsing, it can be a sign the system is choosing what survives. Not by conspiracy, by margin, by funding, by math. So don't just stare at the gold chart. Listen to what it's telling you. Somewhere, someone needed cash to keep the machine alive, and the next cycle will be built on who endured this moment. If you want the next part, I'll do a clean breakdown. What stabilized, what didn't, and which signals turned first. Subscribe for the next update and comment one thing you're watching right now.